Something extraordinary is happening in the gold market right now, and if you're not paying attention, you're about to miss one of the most significant wealth transfers in modern financial history. For decades, the price of gold has been determined not by physical metal changing hands, but by paper contracts traded on exchanges. Futures contracts, ETFs, derivatives, digital entries in a ledger that represent gold, but aren't actually gold. And here's the thing most people don't realize. There's roughly 100 to 300 times more paper gold being traded than physical gold that actually exists. Think about that for a moment. For every ounce of real, physical gold sitting in a vault somewhere, there are potentially 100 to 300 paper claims on that same ounce. It's like a game of musical chairs where there's one chair and 100 people playing. Everything works fine until the music stops. And right now, the music is starting to slow down. Let me show you what's happening. The paper gold market, primarily centered around the COMEX in New York and the LBMA in London, has been the price discovery mechanism for gold for generations. When you see the gold price flash across your screen, that's not the price of physical gold changing hands. That's the price of paper contracts being traded between banks, hedge funds, and speculators who have zero intention of ever taking delivery of actual metal. This system has worked for a long time because everyone agreed to play by the same rules. But something fundamental is shifting. Physical gold is becoming increasingly difficult to source at the paper price. Premiums on coins and bars have exploded. Delivery times have stretched from days to weeks, sometimes months, and the people who actually want to hold gold in their hands are discovering that the price they see on their screen and the price they have to pay in reality are two very different numbers. Here's where it gets interesting. Central banks around the world have been buying physical gold at a pace we haven't seen in over 50 years. They're not buying paper gold. They're not buying ETFs. They're demanding physical delivery of actual metal, and they're taking it out of the system entirely. They're repatriating their gold from foreign vaults. They're building new storage facilities. They're acting like they know something is coming. And they do. The paper gold system relies on something called fractional reserve bullion banking. Just like regular banks don't keep all your deposits in cash in the vault, bullion banks don't keep all the gold they've sold in their vaults either. They operate on the assumption that not everyone will want their gold at the same time. It's a reasonable assumption until it isn't. We've seen this movie before. In 1971, countries around the world started demanding their gold back from the United States. They wanted to exchange their paper dollars for physical gold, as they were entitled to do under the Bretton Woods system. And you know what happened? President Nixon closed the gold window. He simply said no. The United States defaulted on its promise to exchange dollars for gold because there wasn't enough gold to meet the demand. That was the moment the dollar became a pure fiat currency, backed by nothing but faith and the full credit of the U.S. government. And here's the crucial point. It happened because too many people wanted physical gold at the same time, and there wasn't enough to go around. We're approaching a similar moment right now, but on a much larger scale. The difference is that this time it's not just governments demanding physical gold. It's institutions. It's wealthy individuals. It's entire nations trying to de-dollarize their reserves. And the paper gold market is starting to crack under the pressure. Look at what happened recently with the COMEX. Traders who were short gold futures contracts, meaning they had promised to deliver gold at a certain price, suddenly found themselves facing delivery demands they couldn't meet. The cost to roll those contracts forward, to essentially kick the can down the road, spiked to levels we rarely see. That's not normal market behavior. That's stress. That's the sound of a system straining under pressure it wasn't designed to handle. And it's not just the COMEX. The LBMA, which handles the vast majority of wholesale gold trading in the world, has been experiencing similar tensions. There have been reports of difficulty sourcing physical gold to meet delivery obligations. Premiums for immediate delivery have been rising. The spread between the paper price and the physical price has been widening. This is what a market dislocation looks like in its early stages. This is what happens when the paper price and the physical price start to diverge. And once that divergence begins, it tends to accelerate. Here's why this matters to you. If you own paper gold, whether it's futures contracts, certain ETFs, or gold certificates, you don't actually own gold. You own a promise that someone will give you gold, or the cash equivalent, at some point in the future. And if we're entering a period where physical gold becomes scarce, where delivery becomes difficult or impossible, that promise might not be worth what you think it's worth. We saw a preview of this during the chaos of early 2020, When markets were melting down and everyone was scrambling for liquidity, something strange happened in the gold market. The price of gold futures in New York and the price of physical gold in London diverged by over $70 an ounce. That's enormous. That's a market breaking. What happened was that the people who were short gold futures couldn't get physical gold to New York to make delivery because flights were grounded and refineries were closed. The paper market said gold was worth one price, but if you actually wanted physical gold delivered to a specific location, you had to pay a massive premium. The system almost broke. Central banks had to step in. The rules had to be changed temporarily to allow London gold bars to be used for COMEX delivery, something that wasn't normally allowed. That was a warning shot. That was the market showing us that the paper and physical markets are not the same thing. And under stress, they can diverge dramatically. And the stress we're seeing now is not temporary pandemic-related chaos. This is structural. This is fundamental. This is the result of decades of paper gold creation finally running into the hard reality of limited physical supply. Let me paint you a picture of what's driving this. China has been accumulating gold for years, but recently they've accelerated. They're not just buying gold, they're building an entire alternative gold market infrastructure. The Shanghai Gold Exchange now rivals the LBMA in terms of volume. And here's the key difference. Shanghai deals primarily in physical gold. When you trade on the Shanghai Gold Exchange, you're trading actual metal, not paper contracts. You can take delivery. You can walk away with physical gold. This is a direct challenge to the Western paper gold system. And it's working. More and more gold is flowing east. More and more trading is happening in physical markets rather than paper markets. The center of gravity in the gold market is shifting, and with it, the pricing mechanism is changing. Russia has been doing something similar. After being cut off from Western financial systems, they've been settling trade in gold. They've been encouraging their central bank to accumulate gold. They've been building connections with other countries who want to trade outside the dollar system. And all of this requires physical gold, not paper gold. The BRICS nations, Brazil, Russia, India, China, and South Africa, along with their expanding membership, have been discussing a gold-backed trade settlement system. Now, whether this actually happens or not is almost beside the point. The fact that major economies are even discussing alternatives to the dollar system, alternatives that involve gold, is changing behavior. It's changing how central banks think about their reserves. It's changing how much physical gold they want to hold. And this is where the math becomes a problem for the paper gold system. If the paper gold market is 100 to 300 times larger than the physical gold market, and even a small percentage of paper gold holders decide they want physical delivery, there isn't enough gold to go around. It's mathematically impossible. Think about it like this. The entire above-ground stock of gold that's ever been mined in human history is estimated at around 200,000 tons. Sounds like a lot, right? But the notional value of the paper gold market, all the futures contracts, all the unallocated gold accounts, all the derivatives, is estimated to be somewhere between $200 trillion and $300 trillion. At current gold prices, that would represent millions of tons of gold. Gold that doesn't exist. This works fine as long as it's just a paper trading game. As long as people are happy to settle in cash. As long as nobody actually wants the physical metal. But the moment that changes, the moment a significant number of participants say, "I want my gold," the system breaks. And we're starting to see the early signs of that break. Premiums on physical gold coins and bars have been elevated for months. Dealers are reporting difficulty sourcing inventory. Mints around the world are struggling to keep up with demand. These are not the signs of a healthy liquid market. These are the signs of a market where physical demand is outstripping supply, even while the paper price remains relatively controlled. Here's what's particularly interesting. Despite record central bank buying, despite elevated retail demand, despite all the geopolitical chaos and monetary uncertainty, the paper gold price has been relatively well behaved. It's gone up, sure, but not explosively, not in a way that reflects the underlying physical market stress. And that tells you something important. The paper market is still setting the price, but it's becoming increasingly disconnected from physical reality. This can't last. At some point, the physical market will assert itself. At some point, the people who want actual gold will refuse to accept the paper price. They'll pay whatever they have to pay to get physical metal. And when that happens, when the physical price starts to run away from the paper price, that's when things get really interesting. Because once that divergence becomes obvious, once everyone can see that paper gold and physical gold are trading at different prices, confidence in the paper system evaporates. Why would you hold paper gold at $2,500 an ounce if physical gold is trading at $3,000 an ounce? You wouldn't. You'd try to convert your paper gold to physical gold, and so would everyone else. And that's when the system breaks completely. This is what's known as a short squeeze, but on a scale we've never seen before. The people who are short gold, who have promised to deliver gold they don't have, will be forced to either deliver physical metal or buy back their positions at any price. And if there isn't enough physical gold available, which there isn't, prices will spike to whatever level is necessary to balance supply and demand. We've seen smaller versions of this in other markets. The silver squeeze of 2021 gave us a glimpse. The nickel market blow-up on the London Metal Exchange showed us what happens when shorts can't deliver. But gold is different. Gold is bigger. Gold is more important. Gold is the foundation of the entire monetary system, whether officially or unofficially. A gold market dislocation would have implications far beyond just the gold market. Now, let me address something important here. If you're thinking about your retirement, if you're sitting on significant assets in traditional retirement accounts, this is something you need to understand. Because when the paper gold market breaks, when physical gold becomes the only gold that matters, the wealth transfer is going to be enormous. The people holding physical gold will see their wealth increase dramatically. The people holding paper gold might find themselves holding worthless promises. Quick aside here, and this is important. If you have $100,000 or more in retirement accounts, there's a way to hold physical gold inside those accounts without triggering taxes or penalties. It's called a gold IRA, and I've put together a comprehensive guide that explains exactly how it works. You'll find it in the description below. It covers the mechanics, the rules, the benefits, and the potential pitfalls. If protecting your retirement savings with physical gold is something you're considering, that guide will give you everything you need to know. Worth checking out. Anyway, back to what's happening in the market right now. Because the timing of this potential detachment is crucial. We're not talking about something that might happen in 10 years. We're talking about something that could happen in the next 12 to 18 months, possibly sooner. The catalysts are lining up. Basel III regulations, which were supposed to change how banks treat gold on their balance sheets, have been creating pressure in the system. These regulations essentially require banks to hold physical gold, not paper gold, if they want to count it as a Tier 1 asset. That's a big deal. That's a regulatory push toward physical gold and away from paper gold. Then you have the geopolitical situation. The weaponization of the dollar through sanctions has made countries nervous about holding dollar reserves. They're diversifying into gold, but not paper gold that can be frozen or seized. Physical gold that they control in their own vaults, in their own countries. You have the monetary situation. Central banks around the world have printed unprecedented amounts of money. They've expanded their balance sheets to levels that would have been unthinkable a generation ago. And while they talk about fighting inflation, about normalizing policy, the reality is that they're trapped. They can't raise rates too much without breaking something. They can't shrink their balance sheets too much without causing a crisis. So they're stuck, and everyone knows it. And when people lose faith in the ability of central banks to maintain the value of fiat currencies, they turn to gold. You have the supply situation. Gold mine production has been essentially flat for years. It's getting harder and more expensive to find and extract gold. The easy gold has been mined. What's left requires more energy, more capital, more time. Meanwhile, demand is increasing. Central banks are buying. Retail investors are buying. Institutions are starting to allocate. The supply-demand fundamentals are the tightest they've been in decades. And you have the technical situation in the paper markets. Open interest in gold futures has been at elevated levels. The concentration of short positions among a small number of banks has been extreme. The cost of maintaining those short positions has been rising. These are all signs of a market under stress, a market where the shorts are struggling to maintain control. When you put all of these factors together, you get a picture of a market that's primed for a major dislocation. A market where the paper price and the physical price are going to diverge, and diverge dramatically. And when that happens, the wealth transfer is going to be historic. Let me give you a historical parallel. In 1980, gold hit $850 an ounce. In today's dollars, adjusted for inflation, that's over $3,000 an ounce. But here's what most people don't know. In 1980, if you wanted to buy physical gold, you often had to pay a significant premium over the spot price. The paper price was $850, but physical gold was trading at $900, $950, sometimes over $1,000 an ounce, depending on the form and the dealer. That was a preview of what we're about to see, except this time the divergence is going to be much larger and much more sustained. Because in 1980, the paper gold market was much smaller. The leverage in the system was much lower. The amount of paper gold relative to physical gold was a fraction of what it is today. So when the squeeze happened, it was intense but relatively brief. This time when the squeeze happens, it's going to be bigger and longer because there's so much more paper gold that needs to be unwound. And here's the thing that keeps me up at night. Most people have no idea this is coming. Most investors, even sophisticated investors, don't understand the difference between paper gold and physical gold. They think gold is gold. They think an ETF is the same as a gold coin. They think a futures contract is the same as a bar in a vault. And they're about to learn a very expensive lesson. The smart money knows this. That's why central banks are buying physical gold at record rates. That's why billionaires are accumulating physical gold. That's why family offices are allocating to physical gold. They understand that when the system breaks, when the paper gold market detaches from the physical gold market, the only gold that will matter is the gold you can hold in your hand. This is not about being a gold bug. This is not about predicting the end of the world. This is about understanding market structure and recognizing when that structure is under stress. The paper gold market is a house of cards built on leverage and promises, and houses of cards don't fall slowly. They fall all at once. We're seeing the warning signs now, the elevated premiums, the delivery delays, the central bank buying, the geopolitical tensions, the monetary instability. These are not random events. These are symptoms of a system that's breaking down. And when it finally breaks, when the paper price and the physical price detach completely, the people who understood this and positioned themselves accordingly are going to be very, very glad they did. Think about what this means practically. If you own shares in a gold ETF, what do you actually own? You own shares in a fund that owns gold or claims to own gold. But can you take delivery of that gold? In most cases, no. If there's a run on physical gold, if everyone wants their gold at the same time, what happens to your ETF shares? They might maintain some value, but will they track the physical gold price? History suggests they won't. If you own gold futures contracts, what do you own? You own a promise that someone will deliver gold to you at a certain price on a certain date. But what if they can't? What if there isn't enough gold to deliver? You'll get cash settled at the paper price, while physical gold is trading at a much higher price. You'll have missed the entire move. This is why the distinction between paper gold and physical gold matters. This is why understanding the structure of the gold market matters. Because when the detachment happens, and it's looking more and more like when, not if, the people holding physical gold are going to be in a very different position than the people holding paper gold. And it's not just about price appreciation. It's about having an asset that can't be frozen, can't be seized, can't be inflated away. Physical gold in your possession is outside the financial system. It's not someone else's liability. It's not dependent on a counterparty keeping their promise. It's real, tangible wealth that has maintained its value for thousands of years. The paper gold system was created for convenience. It was created to make gold easier to trade, easier to store, easier to use in the modern financial system. And it worked, for a while. But like all systems built on leverage and promises, it has a breaking point, and we're approaching that breaking point now. The question you need to ask yourself is this. When the paper gold market detaches from the physical gold market, when the price you see on your screen and the price you have to pay for actual metal diverge dramatically, which side of that divide do you want to be on? Do you want to be holding paper promises? Or do you want to be holding physical metal? The answer seems obvious when you put it that way, but most people won't act until it's too late. Most people will wait until the detachment is obvious, until physical gold is trading at a massive premium to paper gold, and by then it will be too difficult and too expensive to make the switch. This is your warning. This is your opportunity to position yourself before the crowd figures it out. Because once the crowd figures it out, once everyone realizes that paper gold and physical gold are not the same thing, the rush to physical gold is going to be unlike anything we've seen before. And there simply isn't enough physical gold to meet that demand at anywhere near current prices. The price of gold is about to detach from paper. The physical market is about to assert itself. And the people who understand this and act accordingly are going to be positioned for one of the greatest wealth transfers in modern history. The question is, will you be one of them?